Money laundering is not just a financial crime, it's a global threat. It fuels corruption, terrorism, organized crime, and human trafficking. Every year, trillions of dollars move through the international financial system, and much of that money originates from criminal activity. In the United States and around the world, anti-money laundering, or AML laws, protect the integrity of our economies and the safety of our communities. This training program will help you understand your legal duties under U.S. AML laws and how those responsibilities fit into the global network of international standards designed to stop money laundering and terrorist financing. Even if your company operates entirely inside the United States, you are still covered by America's anti-money laundering laws. The U.S. government considers AML compliance essential to preventing financial crimes, protecting consumers, and maintaining trust in the financial system. The Bank Secrecy Act, or BSA, enacted in 1970, was America's first major anti-money laundering law. It requires businesses to keep detailed records of financial transactions, identify customers, and report activities that could indicate money laundering. The USA Patriot Act, passed after September 11, 2001, expanded those duties, linking money laundering to terrorist financing and strengthening reporting obligations for financial institutions. Both laws are enforced by the Financial Crimes Enforcement Network, or FinCEN, a bureau of the U.S. Department of the Treasury. FinCEN collects, analyzes, and shares financial data with law enforcement and intelligence agencies to identify criminal and terrorist networks. Even non-financial businesses can fall under these rules. For example, a car dealership, jewelry store, or real estate brokerage that accepts large cash payments may be required to report those transactions. If your business receives more than $10,000 in cash, either in a single transaction or through related ones, you must file IRS Form 8300 within 15 days and keep a copy for 5 years. Failing to do so can result in penalties, audits, and even criminal charges. The term financial institution under federal law covers much more than banks. It includes credit unions, broker-dealers, futures and commodities firms, mutual funds, money services businesses such as transmitters, check cashers, and prepaid card providers, casinos, insurance companies, and even some retail operations that handle large amounts of cash or digital payments. Each type of institution has its own section under the Code of Federal Regulations, Chapter 10. For instance, Part 1020 applies to banks, and Part 1022 applies to money services businesses. Money service businesses must also register with FinCEN before they begin operating, ensuring transparency and traceability in the financial ecosystem. Every covered financial institution must maintain a written, board-approved AML program built on 5 key pillars: internal controls to ensure compliance, a designated BSA or AML compliance officer, ongoing employee training, independent testing or auditing, and customer due diligence, including identifying beneficial owners of legal entities. These 5 pillars form the backbone of a compliant AML program. They ensure accountability, consistency, and awareness throughout your organization. In recent years, FinCEN has emphasized the importance of a risk-based approach, tailoring your AML efforts to the products, customers, and geographies you serve. For example, a small local credit union faces different risks than an international money transfer company. FinCEN's national AML and counter-terrorist financing priorities highlight the top threats, such as corruption, cybercrime, terrorist financing, fraud, drug trafficking, human trafficking, and proliferation financing. Your AML program should reflect these evolving risks. At the heart of AML compliance is one simple principle: know your customer. When you understand who your customers are and what's normal for them, you can more easily detect when something isn't right. Banks and other covered institutions must implement a Customer Identification Program, or CIP, to verify identity, provide notice, and maintain records. This involves collecting identifying information like a name, address, date of birth, and taxpayer identification number, and verifying it using reliable documentation. In addition, Institutions must conduct customer due diligence, or CDD, to understand the nature and purpose of customer relationships and to monitor accounts for unusual or suspicious activity. For legal entity customers, this includes identifying and verifying beneficial owners, the individuals who ultimately own or control the company. Even if your organization isn't a financial institution, adopting basic KYC practices, such as identity verification, sanction screening, and documentation of expected activity, helps protect your business from fraud, tax evasion, and potential AML violations. Strong KYC programs also support compliance with reporting obligations, such as Form 8300, and can be invaluable when investigating suspicious transactions later. Reporting is one of the most visible and critical elements of AML compliance. When suspicious activity is detected, financial institutions must act quickly. They must file a Suspicious Activity Report, or SAR, generally within 30 days of detection, or within 60 days if no suspect has yet been identified. Banks file SARs for transactions of $5,000 or more when a suspect can be identified, or for $25,000 or more even if no suspect is known. Money service businesses file SARs for transactions of $2,000 or more. Common red flags include structured transactions designed to avoid reporting thresholds, frequent large cash deposits inconsistent with a customer's business profile, and rapid movement of funds with no clear purpose. They must also file currency transaction reports, or CTRs, for cash transactions exceeding $10,000 in a single business day, and keep records for 5 years. These reports help law enforcement identify patterns of money laundering or other financial crimes. Non-financial businesses must also comply by filing Form 8300 for cash receipts above $10,000 and providing annual customer statements confirming the reports. For electronic transfers of $3,000 or more, the travel rule requires that payment information, including sender and recipient details, travel with the transaction. This rule ensures transparency and traceability in the movement of funds, even across institutions. Financial institutions also participate in FinCEN's 314A and 314B programs, which allow for secure information sharing between law enforcement and financial institutions to detect money laundering and terrorist financing. Sanctions compliance is a critical part of every AML program. The Office of Foreign Assets Control, or OFAC, enforces U.S. economic and trade sanctions. Financial institutions and many non-financial businesses must screen customers, vendors, and payments against OFAC's lists of prohibited parties, including the Specially Designated Nationals, or SDN list. But compliance doesn't stop at America's borders. Many organizations also check against the United Nations Security Council sanctions list, the European Union sanctions map, and the United Kingdom's Office of Financial Sanctions Implementation, or OFSI. Screening isn't a one-time exercise. Names, entities, and countries under sanction change frequently, sometimes daily. Effective programs integrate automated screening tools, real-time updates, escalation procedures, and detailed documentation of any decisions to block or reject transactions. Remember, sanctions violations, even unintentional ones, can lead to multi-million-dollar fines and serious reputational harm. Money laundering is a global problem that requires a global response. The Financial Action Task Force, FATF, leads that effort. Established in 1989 by the G7, FATF is an intergovernmental body that sets international standards to combat money laundering, terrorist financing, and the financing of weapons of mass destruction. Today, FATF standards are followed by over 200 countries through a network of regional bodies called FATF-style regional bodies, FSRBs, such as Moneyval in Europe, APG in Asia-Pacific, and CFATF in the Caribbean. The 40 recommendations are the global blueprint for AML and counter-terrorist financing programs. They guide how countries and institutions should prevent, detect, and respond to financial crime. They cover risk-based approach, assessing and mitigating AML-CFT risks proportionately. Preventive measures, performing due diligence, identifying beneficial owners, and monitoring transactions. Transparency, requiring accurate beneficial ownership records to prevent shell company abuse. Reporting, ensuring suspicious transactions are promptly filed with Financial Intelligence Units, or FIUs. Supervision, licensing and auditing financial institutions and designated non-financial businesses. International cooperation, sharing information and supporting cross-border investigations. Targeted financial sanctions, freezing or blocking assets tied to terrorism or proliferation. And emerging technologies, regulating cryptocurrency and virtual asset service providers, or VASPs. FATF monitors compliance through mutual evaluations and public gray and black lists. Countries with deficiencies face restricted international banking access, higher transaction costs, and reputational harm. Even for U.S. businesses, FATF standards shape FinCEN, OCC, SEC, and OFAC expectations. Following FATF's 40 recommendations isn't optional. It's global best practice and a cornerstone of ethical business conduct. Under the Corporate Transparency Act, most U.S. companies must report their beneficial owners, the individuals who ultimately own or control the business, to FinCEN. This rule prevents criminals from hiding behind shell companies or anonymous ownership structures. The reporting process includes providing identifying information for each beneficial owner and company applicant. Because these rules continue to evolve, organizations should monitor FinCEN's beneficial ownership information updates to stay current on definitions, exemptions, and filing deadlines. Transparency is not just a regulatory requirement. It's a safeguard that builds trust with customers, investors, and regulators alike. AML enforcement is serious, and the penalties can be severe. Regulators assess whether programs meet the 5 pillars, include proper risk assessments, and address the national AML and CFT priorities. Civil and criminal penalties may include heavy fines, loss of licenses, reputational damage, and imprisonment for executives who knowingly fail to maintain compliance. Recent enforcement cases have shown that regulators expect leadership engagement and a culture of compliance from the top down. Failing to file SARs, ignoring sanction screening, or maintaining weak internal controls can all result in enforcement actions. Remember, AML compliance isn't just a box to check. It's an ongoing commitment that protects both your organization and the communities you serve. To protect your organization, follow this global compliance checklist. Determine whether your company qualifies as a financial institution under U.S. or foreign law. Adopt a written, risk-based AML program designed with both U.S. and FATF standards. Implement CIP and CDD, including beneficial ownership verification. File SARs, CTRs, and Form 8300 reports on time. Maintain all AML records for at least 5 years. Integrate OFAC, UN, EU, and UK sanction screening. Align your risk assessment with FinCEN's national priorities and FATF principles. Provide annual training and independent testing for all relevant staff, and cooperate with financial intelligence units such as FinCEN, FinTrack, and the NCA when appropriate. Creating a culture of compliance means more than meeting minimum legal requirements. It means ensuring that every employee understands their role in detecting and preventing suspicious activity. It means encouraging open communication with compliance teams, documenting findings thoroughly, and reporting issues promptly. When compliance becomes part of your organization's identity, embedded in training, operations, and leadership, you build long-term resilience against financial crime. Money laundering doesn't stop at national borders, and neither does compliance. Even if your company operates only within the United States, your vigilance contributes to a global effort to protect the financial system from crime and corruption. By maintaining a strong, risk-based AML program, training employees regularly, screening for sanctions, and reporting suspicious activity, you help safeguard your organization and uphold the integrity of the entire financial world. Together, through knowledge, vigilance, and compliance, we can stop money laundering at its source.